Because, like, for this one, for example, I had people like, rates are going to go down, rates are going to go down. Friends, the rates are already down because when you're locking a mortgage interest rate, you're locking it for 30 days generally, which means whatever rate that was locked is baking in what they think is going to happen in the next 30 days. The general consensus pre this meeting was that it was going to drop by 25 basis points.
Correct.
That was already wrapped into the mortgage rates. We had seen a slow decline in mortgage rates for a few weeks prior to that meeting. Now, what happened after that meeting? Rates went up. Oh my God. Why? Because the commentary was not as favorable for the amount of rate cuts that mortgages would like.
Correct.
Okay. So rates went up. So rates actually went up pretty decently the 2 days after that Fed meeting. How isn't that counterintuitive, Derek? Right? Fed drops the rate, mortgage rates go up.
Yeah, no, I mean, that like on its face doesn't make sense. But when you explain it like, hey, look, they're forward looking, they're trying to project out. They have what's called a dot plot where they project out, okay, these are the rates cuts are going to be at this specific time frame. They're not always accurate, but if they follow along those lines and the commentary behind it matches expectations, that's when you see nothing would change.
Yeah.
It's when the expectation is different than the reality is when you see it like either a bump, either positive or negative.